So, big question today. I know you love shortcuts. I know you love ratings, but should you really trust them? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investing, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique, and today we're going to talk about something super simple and yet super complicated. How's it going, Véronique?
I'm doing good, Mike. And you know what? Over the years, there has been like a consensus that a good payout ratio is under 80%, which for investors means that dividend payment is safe. However, this is a bad shortcut and a bad use of the payout ratio. And we'll explain why using extreme examples like negative payout ratios and sky high ones.
Yeah, I mean, as investors, we like to keep things simple. And when you think about that, well, if the payout ratio is under 80%, that makes sense. I mean, the company has plenty of room to grow the business, pay the dividend, and still not being too tight in their budget. But when you think about how the payout ratios are calculated and you realize that they are actually more than one payout ratio, well, then you figure out maybe just applying this to the filter. Yes, it's a shortcut. You cannot really go wrong, but at the same time, you're going to discard a lot of great companies.
So, Mike, quick refresher. What is the payout ratio? Like, are we talking quarterly, annual?
Yeah, so many things for something that is so easy, right? So the payout ratio, I mean, it's like just two numbers: the dividend paid divided by the earnings per share. Most of the time, what you're going to see on a website is either the 1 year, so either calendar year, or what we call trailing 12 months, so the TTM, so the past 4 quarters. In general, this is the most used, but again, that could be kind of complicated in a sense where the company may have increased their dividend in the meantime, or had a very, very bad quarter, and then it could completely transform that ratio. But most of the time, it's the dividend paid over the past 12 months divided by the earnings per share over the past 12 months. And there you have that magical percentage telling you if the dividend is safe or not.
And why do we calculate payout ratios in the first place? Like, what decision does it help with?
Well, it's great to know what is the percentage of earnings, or almost in other words, of profit that is dedicated to the payment of the dividend. It gives you a good idea if the business has enough room there to grow the business, make other acquisitions, or pay off the debts and still pay the dividend. So it's like knowing how much you pay in groceries in your budget. So it helps you to understand if you're eating too much, or maybe your grocery budget is really small and then you have like a very large restaurant budget. So it's important to understand where the money goes. The dividend payout ratio is also a good metric to know if it's sustainable or not. Because, for example, if you're always above 100%, that means that you're spending more than the earnings that you're making. So technically, there's something wrong. You need to investigate a little bit more. But if you go it for the simplest explanation, if you pay more than what you earn, well, you go into debt to pay the dividend, which is definitely not sustainable over the long run.
And like you've mentioned, one bad quarter can mess up the numbers. It was the case for banks in 2020. So, how should listeners add context?
Yeah, so 2020, COVID hits, then banks review their portfolio and they figure out if they have loans to restaurants or hotels or anything around leisures that are completely closed. Chances are their provision for credit losses must be increased. And the provision for credit losses increased affect the earnings, and therefore the payout ratio goes through the roof. Then it's really important to understand what really happened, because that was a temporary situation, not a long-term thing that is going to be permanent in the future. I read articles back then saying that Starbucks had a very high chance of cutting their dividend because, of course, if you look, and it's kind of funny because that was the title of the article was like some things like, oh, those 10 companies have a very likelihood to cut their dividend in the next like few months. And then you read the articles and literally the guy just pull out the payout ratios of all those companies that were closed during COVID and say, well, if they're losing money or they have little earnings, of course the payout ratio goes through the roof. And based on very disgusting payout ratios, he just said, well, those companies are going to cut their dividend. So without context, without understanding what's happening, if you just look at the numbers, and it's the case for most financial metrics anyway, if you just look at a number and then you try to draw a conclusion out of them, most of the time they're going to be wrong. You need to add that context. So a good way to add context is to actually dig into the quarterly earnings and see what caused the earnings to go down so fast that the payout ratio exploded altogether.
By the way, listeners, last week we digged a bit into quarterly earnings review, which was like our webinar replay summary last week. And I believe that it was really appreciated. So if you didn't listen to it yet, go in the show notes and I will put the link. This is thedividend.blog.com/247. Mike, which version should we use by business type? Because like you said, there is the classic payout ratio, the cash payout ratio, then there's GCF, there is FFO, AFFO. What's going on here?
Yeah, and this is where it gets interesting, right? And the math nerd in me is just like dancing around right now because we're just like, ooh, now we get into the complex stuff. So of course, when you start, you look at the company's payout ratio, or you're going to start with the classic one, the dividend divided by the earnings per share. It's going to give you the first metric to see what happens, and then you can look at the graph as well over the past few quarters where it was going. Then the important part is to understand the business model. So in terms of business model, what we mean is like understanding how the business is making money and if it's capital intensive or not, for example. So when a business is capital intensive, that means that it requires a lot of capital to be invested in maintaining their business and also growing the business. So you can think of like telcos, pipelines, companies with a lot of acquisitions, for example. Well, when you're all capital intensive, if you look at the balance sheet, you will see that they are in the financial statement, you will see a lot of amortization. The amortization is an accounting number, but doesn't affect cash flow. So for that reason, the payout ratio will be higher, but it's not necessarily why the company is able or not able to pay the dividend in the first place. A good way, once again, to understand which type of payout ratio you must use is to look at the quarterly earnings. And we have discussed that in the webinar that you just mentioned, where when you read the press release, management will have a focus on either the payout ratio, the cash payout ratio, and you can see that for like TELUS over the past few years has been on the radar for many investors. They are scared that the dividend will be cut, especially after BCE cut their dividend at the beginning of this year. And one of the thing was it shows a payout ratio above 100%. But when you look into their financial statements, in the investors presentation, TELUS focused on the cash payout ratio. So they're already telling you, yeah, you should probably discard the payout ratio and focus on the cash payout ratio. Same thing with the distributable cash flow payout ratio, the DCF payout ratio, that is used by companies in the pipeline industry such as Enbridge. But Enbridge has a full slide in their earnings presentation every single quarter explaining you the difference between earnings and DCF and then calculating the DCF payout ratio. And their target is based on that metric, not the classic one. So as you read financial statements, and if you ignore financial statements, you'll never know unless you're a DSR members, because we are actually telling you which payout ratio to use in our stock cards, but it's a good way to understand it. For FFO and AFFO, that stands for funds from operation and adjusted funds from operation. Those are for REITs most of the time. So once again, if you read any financial statements or press release from a REIT, you will have the FFO and AFFO payout ratio outlined in all of them. So it's a good way to take a shortcut, not necessarily have to go through the entire business model if you just want to know which metrics to follow, and then you'll be aware of it. The downside, though, is when you're thinking about the DCF or the FFO, or even you'll have like distributable earnings payout ratio, all of those numbers are not based on GAAP numbers, or not based on generally accepted accounting principles. So we kind of see them as homemade calculation by the company. So yes, they're not going to fool around with those numbers, but still, it's not necessarily standard. So you cannot always compare one company to another. So you have to compare versus their history. Because it's one thing to play around the numbers, but over time, you cannot really fake a dividend or a distribution. It's literally money getting out of their corporate bank account. So if the dividend keeps on increasing, and they show you the DCF and for Enbridge, for example, well, probably that their calculations are not that bad because they have been increasing their dividend for decades now.
And talking about history or the trend, how far do you look back?
So, Dividend Stocks Rock, we provide 10 years of data. I prefer to focus on the last five because sometimes 10 years ago starts to be a while and the business is completely different. I mean, keeping on talking about Enbridge, 10 years ago, the company used to increase its dividend by 10%. And now we're like on a regular 3% increase every year. So, completely two different landscape. So probably that the payout ratio is a bit different as well. It's important to add economic context. So again, if you look at 2015, 2016, 2017, we're completely not in the same economic context that we have right now or a few years ago when inflation was sky high. Well, in 2016, inflation was not even part of our vocabulary at all. So people ignore that completely. Today, we keep on tracking this number even to this date. So it's kind of interesting to see how things evolve. So when you look at the trend, it's one thing, but then you have to put it back into a context and see how the company was doing back then, especially if you go 10 years ago. 5 years, it's a little bit better. But again, I mean, exactly 5 years ago, we were still in the middle of COVID crash. It was getting back on. So the payout ratio is probably a bit funky when you look at 2020 numbers. So you might as well ignore it and start in 2021 or go back to 2019 or 18 and just ignore 2020 altogether.
And another reason not to discard a company because of its payout ratio, whether it's high or low, is because payout ratios can differ from an industry to another. How can we know what's normal for each?
Well, I always like to start with looking the trend of a company itself just to see where that business has been in terms of like distributing their dividend versus their earnings. And then I will look at their peers, at like other companies in the same industry. It's important to not compare in the same sector, but rather go into what we call subsectors or industries to be as specific as possible. One example I can think of is sometimes people will tend to compare life insurance companies with personal and casualty insurance. So yes, there are two type of insurance companies, but one is about life, usually have a large part into wealth management, and the other one, like Intact Financial, for example, will focus on personal and commercial insurance for like cars, houses, and businesses. So completely different type of business model in that terms. The risks are not really the same. The ways of making money, yes, it's the same principle, but you cannot really compare those ratios. So it's really important to have like a business that is a direct competitor, literally. So you're not going to call Sun Life and then call Intact. You might actually be insured with both, and it's going to be fine. They're not necessarily
Right.
competing for most of their products.
And now let's dig into like the extreme examples. What usually causes negative payout ratios, and how do we judge if it's temporary?
Well, negative payout ratio is pretty clear. It's the business losing money. So either cash
Mhm.
payout ratio or the regular earnings. So if you have negative earnings or negative cash flow. So in other words, the company is kind of forced to borrow money to pay the dividend. It's not always the case with the classic payout ratio, as I mentioned, because you could have like a major impairment, for example. You can write off an asset from your financial statement, causing a one-time loss in your quarter. And then the payout ratio would look like being negative, but you just wrote off goodwill out of your financial statement. So you did not write a check for that. But then again, it's important to add context to understand what happened. And the reading of the financial earnings and the quarterly earnings is super important to understand what really happened. And then you can be able to judge if it's temporary or not.
And how long should we wait for the payout ratio to return to a normal state?
Well, it really depends on what happened. So if we take like the example of a company that did a write-off, that's going to stay in the financial statements for a year. So after a year,
Hmm.
it's going to fully recover. Or you can look at the adjusted earnings and calculate the payout ratio yourself. Those are ways that you can do it. Sometimes you're going to see that on those payout ratios graph that you'll see a big spike or a big drop if it goes into negative. But adding that context will tell you, okay, so it's a one-time thing. It's going to last for 12 months. And after that, it's going to be all good. We also saw a lot of good examples on the other sides where you had like a surge of earnings after COVID. So in 2021, we had a lot of companies that surfed on various waves where they were making so much money at that time. So revenue and earnings skyrocketed, bringing down the payout ratio super low. But after this, what I would call COVID hype, 2 years later, then revenue and earnings drop back to what they were before or just showed normal growth after a big bump. And then, of course, the payout ratio will go back to normal levels. So it's all about studying those graphs and then looking at whenever there's a movement, you look into the quarterly earnings to understand what really happened.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
You mentioned Starbucks earlier, which went sky high during COVID. So when a ratio goes up to like 200% or plus, what's your quick checklist?
So, first things first, I always look at what really happens overall. So, what's
Mhm.
happening on the stock market? What's the economic environment look like? Are we in a recession? Like, what's going on outside of the business that could affect Starbucks? And then I will look at the numbers and see what really is happening. So, in this case, kind of easy because you're just like, okay, so all the restaurants, all the coffee shops are closed. So, of course, you're running out of money, you're not making revenue, and then you're losing money. So, totally makes sense. And then you can determine if it's temporary or a long-term event. So if it's a long-term event, imagine a company struggling growing the revenue quarter after quarter after quarter because the company is not relevant anymore. Can maybe thinking about like printing media, for example, like selling
Mhm.
newspapers, selling magazine, not exactly a thriving business. So it's like in a cyclical downside, it's going to be worse quarter after quarter until the company reinvents itself. So then you can say, well, that is a little bit more long-term event that it will be almost permanent, or that's a huge challenge the company must face versus a crisis like COVID, or if you do a write-off, or if you made a major acquisition, or you sold, like for REITs, sometimes we'll see that when they do asset recycling. If they sold several properties in a quarter or over a year in the expectations of using that capital and buying new properties, maybe they have not completed their asset recycling cycle. So if you sold a bunch of properties on year one, your revenue and funds from operation will reduce. And then if you have not bought new properties during that 12 months and you're still making deals and this capital will be deployed over the next 2 years, well, the AFFO and the FFO will not grow that fast. It's going to grow later on. But in the meantime, the payout ratios are going to be higher and they could exceed 100%. So adding that context, understanding what the business is doing right now, I mean, it makes sense. They're selling assets, they're going to buy new assets, they're going to generate more cash flow in the meantime, but there's a gap period between both, which will put the payout ratio a little bit higher and eventually it's going to go back down to normal. So on one side, when you understand this, you're not going to panic when you see higher payout ratio, but you're not going to jump and dance when you'll see the following year that the FFO payout ratio is lower because now funds are growing. It's just normal. This is what the business intended to do, and that was expected as well.
But then when does a high payout ratio of 100% or more become a real red flag and not just noise?
One thing is really important to look at is other metrics to understand what's going on with the business. So if I see a payout ratio above 100%, I will automatically go see the dividend triangle because the dividend triangle will focus on three metrics: revenue growth, earnings per share growth, and the dividend growth. So, of course, if you see a business that is struggling, so barely no revenue growth, the earnings are declining, and there's a slowdown in the dividend increases, or the company just put a pause on that, and it's been 2 years, 3 years that the dividend is not increasing, well, it's kind of like just adding one red flag after the other. And then you
Mhm.
can tell, well, there's a reason why the payout ratio is above 100% is really just because the business is struggling, is lacking cash flow, has not enough growth vectors, and it's getting killed from the inside. So then the avenue will lead eventually to a dividend cut. It's kind of like the writings are getting on the walls at this point. So what I see here is whenever I see a high payout ratio, I will go look at the dividend triangle. And when I see slowdowns in any of those three metrics, most of the time what happens is you're going to see like slowdowns on several metrics. Well, then you're
Mhm.
just adding more concerns, and it's probably a sign that you should run.
Mike, let's go back to Enbridge for a second. You've said that, we need to look at DCF for this one. You had Enbridge in your portfolio a while ago, but this is not the reason why you sold it, right? This is not because of its payout ratio.
No, not at all. I was not concerned about that. When I sold Enbridge, I sold it at the beginning of 2023. I sold it for two reasons. The first one is really linked to my strategy and my focus. I focus on companies that has an ability to grow their dividend. So I target most of my companies must increase their dividend by at least 5% and more. When I bought Enbridge in 2017, that was the case. It was like on a roll for increasing their dividend double digit, like 10% per year. Fast forward to 2023, it was a few years of a small increase of 3%. Enbridge became more like a deluxe bond or a bond proxy. So a stock that, yes, you're going to see some capital appreciation from time to time. Actually, it's quite cyclical. It goes up, it goes down, but over the long run, the stock price doesn't move that much. The dividend is safe, the yield is generous, kind of like a bond, and it increased a little bit. So that's great, but it's just not enough growth for me. So that was the first reason. The second reason was because of higher interest rates. So it's capital intensive. The company keeps on racking more debt year after year after year. I understand it's the business model to invest massively in those pipelines projects, but at one point, it's not sustainable for the long run. One day or another, they will have to pay down that debt. They cannot just balloon the debt forever. So based on those two factors, I decided to sell. So it was definitely not about the DCF payout ratio that made me uncomfortable, but of course it attracts some criticism as well because it's not a classic way to calculate the payout ratio. You have to be comfortable with that. It's part of the risk if you invest in a company that use those kind of like what I call homemade calculations. It's just part of like the downsides of that business. And maybe at one point they will say, oh, yeah, well, we kind of missed a few things here and now we have to cut the dividend. So if you're comfortable with that type of risk, I mean, no investments are perfect. So there's always something wrong at one point. So you just have to
Right.
monitor it closely.
So, by the way, listeners, I did that on purpose. I just made Mike gave you a concrete example of the analysis you must do for each of your holdings, even though you don't come to the same conclusion. That's your part. So, Mike, you said that you don't use payout ratios in your first filters. Why is it so?
Yeah, when I look for a new stock for my buy list, I never look at payout ratios in the first place. The reason is quite simple. I would discard amazing companies like Broadcom, Costco, or Brookfield. And those show from time to time high payout ratios for specific reasons. I mean, Costco pays a special dividend. So if you look, once they just paid their latest special dividend, if you want to be by the book, you have to consider this special dividend in your payout ratio calculation, but that's going to chew up the numbers a little bit.
Hmm.
If you just look at the regular dividend, you're going to be fine. With Brookfield, it's a super complex company. We have discussed this like several times on the show. So you need to understand the complex nature of it. They go by distributable earnings, not earnings per share. So again, more complicated here. And for Broadcom,
Mhm.
they are like literally an amazing business that grows by through a lot of acquisitions. So most of the time they have acquisition costs, they have amortizations and so on. So from time to time the payout ratio will look ridiculous. But those three companies have amazing dividend triangle, and yet the payout ratio is through the roof. So I rather not add that to my filter. I mean, when you filter, you want to narrow down, but you want to have like a short list of amazing stocks. Adding this filter is not necessarily improving the chance I'm going to find an amazing company, but it's going to also take some great companies away from it that have like a wider range of research instead.
So, Mike, so far it's like the payout ratio is good, yes, but it's like always yes, but. So, how
Yeah.
should investors use it in the end?
I like to see my investment process as like different types of layers. So the first layer is really looking at the dividend triangle. So it's three metrics, keep it simple, but you're already like getting a lot of companies off the table. So it makes your research easier. So that's the first layer. The second layer is to write down your investment thesis. So understand the business model. And this is how we do it at DSR is we have three components of our investment thesis. The first one is the playbook. So you understand how the business makes money, literally. If you cannot explain it to a 12-year-old, you don't understand it, and therefore you must do your research first before you can go further. The second part is how this business is going to grow. So the growth vectors. So it's great that you understand the business model, but how is it able to keep growing the revenue and the earnings? And you must be able also to lay that out very simply. So not just say, oh yeah, this company has been around forever. Yeah, well, that's not enough. How it's going to continue to increase their numbers. And finally, the economic moats, or what you can call the competitive advantage. What makes this business more special than competitors? Like, what is their secret sauce, their special advantage? So once you have laid out the playbook, the growth vectors, the economic moats, now you have a complete investment thesis. That's layer number 2. Then you go into layer number 3, which is the dividend profile, I could say. So then you're going to look at the dividend growth rate, the trend here. Is it like growing faster or slower or pretty much steady? And this is where the payout ratio is interesting. So then you can look at the number itself to identify if there was a problem in the past. If there's a high payout ratio or negative payout ratio, that indicates you that you need to dig a little bit further. And you can also look at the payout ratio trends, because if the payout ratio keeps on growing quarter after quarter for the past 3 years, it's telling you that the dividend growth is likely going to slow down as well. Because I mean, there is no look at the payout ratio as a budget metric. If you're getting tighter and tighter and tighter, at one point you're not going to buy a new car. It's impossible. You're not going to be able to do that. You need to pay down your debt. You need to increase your salary, but you need to do something before you buy the new car. So the dividend is like that new car, which is not necessary for the business at all, actually. So the business is literally paying a dividend to attract investors. But at one point, it doesn't make sense to increase it. Well, they're not going to increase it. And this is where the payout ratio study will be very interesting. And it will help you add that context once you have the first layer of the dividend triangle, the second layer, understanding the business, and the third layer, looking at the dividend profile.
But Mike, is the payout ratio still the best way to avoid dividend cuts? And if not, what is it?
Well, like every single metric taken alone, it's not enough. As we said in this episode, you need to add context. You need to understand what's going on. Of course, if you have bad trends, so a weak dividend triangle where the company struggles to grow their revenue, to grow their earnings, doesn't increase its dividend, and show a high payout ratio, well, then you have your answer. It becomes obvious. So it's an important part of the analysis. You should not discard it at all, but you should never just not start with that. But most of the time when we change our ratings at DSR, it's a combination of a weak dividend triangle and a high payout ratio. Most of the time, we're just going to say, you know what, if they don't cut their dividend, good for you. But I personally would stay away from those companies because I don't see the business thriving. And on top of that, the metrics are telling me that they're getting short on cash to pay me that dividend. And this is why I invest for. I invest for growing dividends. So, of course, high payout ratio, not exactly going aligned with my strategy.
So before we end this episode, Mike, I would like to invite listeners to download our free dividend rockstar list. Why is this list your go-to to identify your next buy?
The Rockstar list is the short version of what we use DSR for our stock screener. And it's really just using three fundamental metrics: the revenue, the earnings, and the dividend growth. What we want is positive numbers for the three of them, so you can narrow down your research, but not too far, and do not discard amazing companies that could have one or two bad financial metrics. So what I think is the metrics are speaking a lot louder than any narrative. So yes, you can tell stories, you can have like a lot of hype about how this company is going to transform the world and be amazing. But if the numbers are not there, you should not fall in love with that narrative or fall in love with that stock. You should fall in love with the metrics. And if the metrics are good, then you're on the right path.
So hit pause and thedividendguyblog.com/rockstar now to get your free copy. Note that it is updated monthly, so look for it in your emails also. Thank you so much, Mike, for sharing your wisdom on payout ratios with us. Listeners, while payout ratios are indicators of a company's health, context must always be added. To quickly identify your next buy ideas, download the Dividend Rockstar list now at thedividendguyblog.com/rockstar. It is the only list using the dividend triangle as a foundation. For our show notes and related content, visit thedividendguyblog.com/247. Next week, we will compare dividend growth investing to the market returns. Hit pause and the subscribe button underneath our podcast logo so you don't miss it. And until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.